copy for your members. Coco, have you sent them the max from last week?
Yes, we have received that.
Yes, I've sent them the max.
Okay, excellent. That's great. Okay, so today the main goal is to complete risk and return, and also to do a quick run through portfolio theory. They Ben do portfolio theory with you. Yes, a moment. Class rep.
Sir.
Yes, have you done portfolio theory?
No.
The guys, you don't seem to know.
No, sir.
Wow. Okay, let me look at. I have a record of what bank said to me, so let me look at. Okay, so we can do a quick run through portfolio theory. Okay, so sorry, I was checking something that can. Okay, so I've checked what Ben sent me. Well, we can still run through portfolio theory quickly since you're not very sure that it has been covered. So I'll finish risk and return, and then we do a quick run through portfolio theory. So it's not going to be very detailed, but I'll cover the essential things you need to know about portfolio construction and optimization. Okay, so last week, just to summarize, we looked at historical returns for various asset classes. We saw that there's a relationship between risk and return, and that as risk increases, expected return increases as well. We looked at a couple of measures as to how to measure return. So we looked at the arithmetic return and we looked at the geometric return. We saw how to calculate both of them. And we saw the instances in which we use the arithmetic return, as well as the instances in which we prefer to use the geometric return. In addition, we also discussed the properties of the geometric return that make it very attractive for use in finance. And then we began the discussion on multi-period returns, and we in particular discussed the dollar return and how to compute the dollar return. Okay, so basically, I think we finished that. The main thing I'll mention is that, so this can be useful in some settings. Okay, so for example, if you have a fund where the fund receives inflows and outflows, okay, it's important to be able to account for the return of the fund, taking into consideration money's coming in, money's going out, dividends coming in, etc. So that makes this a very useful measure. For example, for a fund manager, you want to be able to measure your returns after accounting for inflows and outflows as well. Okay, so that's the multi-period dollar return. That's an example I asked you to try. I hope you did. How many of you were able to try the example? Mr. Class Rep. Okay, Bismarck, I see your hand is up. Were you able to try?
So I tried it, but I wasn't certain with what I got. So I was just waiting for you to take us through a little. Then we know.
Well, it's for you to try. I'm a bit concerned that almost the whole class didn't try it. Okay, and I think automated, all you need to do is put in the figures. Okay, so try it. That'll be my recommendation. And there's some things you should look out for to see if your answer is correct. Okay, so if your answer is correct, you will get the same present value. Okay, so as you see, there's this present value. And if your answer is correct, one indicator is that this will sum to your present value of 50. Okay, so look at the example that we did in class. It's the same example, very similar. I've only changed the numbers. Okay, so Bismarck, one way to check if your answer is correct is if this sums to the PV. Once again, remember we said that the internal rate of return gives us an NPV of 0, i.e. the present value should be the same as, so the present value of the input should be the same as the cost. Is that okay?
Yes,
so if this,
please, the numbers are not showing.
it's not showing because you're supposed to try it. Why should they show?
So because you said we should compare the answers, I should compare with yours.
No, I mean compare it to what you've done. Okay, so yes, this one, if you look at the example we did in class, the answers show. Okay. So like I said, I won't discuss it with you. I think you should. You should try it on your own. It's almost the same thing. I've only changed the numbers. Okay, so it's something you should be able to. So that's what I'm saying. If you notice here, the present value sums to 50. Okay, which is the cost of the investment. So if this wasn't 50, it should tell you that something is wrong. You get the point I'm making. Okay, so I'll leave you to try it. Otherwise, I'll be spoon feeding you too much. I can't do everything. There are examples you need to try on your own. I can't do everything with you. So luckily for you, I've even created a format. Just put in the numbers. Okay, so yeah, Bismarck, try it and if your answer sums to 50, you know you're right. Okay, so let's go to the dollar weighted return. Okay, and basically in this case, we calculate the geometric return for the different time periods. That's why it's called a dollar weighted return. Okay, so remember that in this example that we did last week. So this example we did last week. Okay, so just to recap, we buy a stock at time 0 at $50. At time 1, we buy a second stock, okay, of the same company. So we buy another stock at $53. At time 1, we receive $2 for the first stock. At time 2, we receive $4, which is $2 on the first stock and $2 on the second stock. And again, at time 2, we are able to sell both shares for $54 for a total inflow in time 2 of 108. Okay, so that's just a rehash of the numbers that we saw last week. So we are going to use these same numbers to compute the. Sorry, did I send you the slides last week?
No, sir.
No.
We don't have.
I don't even know what to say. So if you really wanted the slides, what would you have done?
Say I asked for it the other time, and he told us the TO will be sending it to us. We didn't get it.
No, that's not what I said. I said your class rep should. Request for it.
Yeah, I'm
What's
sorry.
your-
Escape me, sir. I'm sorry.
Okay, sure. Okay, so we can continue. Okay, you give me a moment. Let me see if I can. Okay, so these are the full slides I'm using. We can just pull out the portion on risk and return. So class rep, we may want to do it for them. We can pull out a portion on risk and return. Okay, so okay, I guess that's fair. The slides are a bit different from what Ben is using. We are covering almost the same material, but they are slightly different. So you can just pull out the content on risk and return. Okay, so let's go back to the time weighted return. So if you remember, we buy the stock for how much at time 0? 50, right? And then at time 1, we receive a dividend of $2, and we can sell it at the end of year 1 for $53 over the initial cost. So this is more like, again, we've seen this before. This is like the capital gain. 53 minus 50 is a capital gain of 3 plus the dividend of 2 over the initial cost of 50. Or if you like, you can do it inflows minus outflows. So this is 55 minus 50 over 50. Again, that gives you 10%. Exactly. So that's the return for year 1. So note here that we are computing the time weighted return. Okay, in year 2, and this one we don't do it. We don't use the total amounts. Or we don't use the total number of shares. That's a difference. If you remember, for the dollar weighted return, we actually looked at the total amounts. Okay, but here we are interested in calculating it as if we own 1 share. Okay, so we are more interested in the time, not the dollars, the total dollar received. Okay, so here you notice that we didn't use what is 54 times? We didn't use 108. We used 54. For the dividends, we didn't use 4. What did we use? We used 2. Okay, so there's a time. So please note there's a difference between the dollar weighted return and the time weighted return. Time weighted return, we are assuming we own one stock or 1 share. Okay, so this is 54 plus 2 minus the cost of the stock at year 1, which is 53 over 53. And that gives you the return for year 2 to be 5.66%, not 56. Okay, 5.66%. So the return in year 1 is 10%, and the return in year 2 is 5.66%. Okay, and if you remember, do you remember this formula from last week?
Yes, sir.
Miss Mark, are you the only one in the class? Let me see. Who? Oh, for Hima. Do you remember this formula from last week? Are you there? Hima, can you hear me? There's a roll check, so if I don't hear from you, I presume you're not paying attention. Okay, cool. Just take note of that. She's not responding. Who else? Sadiq.
Yeah.
Do you remember this from last week?
Which one? RG. Yes.
Yes. Okay, what did we say about this formula?
I know geometric has to do with the mean, average mean. So with this one, okay, it's a bit.
Okay, so I said that for the geometric return, we don't add. What do? We multiply. Okay, I made that very clear last, so that you don't confuse the two. Okay, so when we looked at the formula for the geometric return, where is it? Okay, here. We looked at an example. Okay. So I said we don't add, we multiply, and then you raise to the power 1. Nice this. Use the power 1 over n minus 1. Okay, so those are the key things. Arithmetic return we add, geometric return we don't add, we multiply. Okay, so if you remember that, then you wouldn't make a mistake. Okay, so again here, because we are computing the compound return and the geometric mean return, we don't add, we multiply. Okay, and then we raise the power 1 over n. Here, how many years do we have? 2 years. Okay, minus 1. So that gives you a time weighted return of 7.81%, which is higher than the dollar return of how much? 7.117%. And there's a reason for this. Okay, the reason why the time weighted return is higher is that, or conversely, the reason why the dollar weighted return is lower is that in year 2, if you look at it critically, in year 2, when we invest more money, the return is lower. Can you see that? So the return in year 1 is 10%. The return in year 2 is almost 6%. But we invest more money in which year? Year 2. Okay, so that causes the dollar weighted return to be lower than the time weighted return, i.e., because we invest more money in year 2 and the returns in year 2 are lower than the returns in year 1, then it reduces our overall return. Does that make sense? Okay, so in years in which we invest more money, and the returns are lower, obviously, to drag our dollar weighted return down. Okay, that's the main point that I'm making. Okay, any questions so far?
Yes, so what's the cause of that? I don't get why we invest more and we have less returns. Maybe I'm not getting it right.
Can you say the first part again? But
Like, what's the reason?
ask a question.
I didn't get that well.
Okay, so what I'm saying is that subsequently, before you ask the question, kindly raise your hand.
Okay, sorry.
Remember, we agreed on that last week.
I'm sorry.
Okay, so please repeat your question.
I was asking for the cause of that, like, except I didn't get you well. You said the reason why it's low, it's because we invest more in the second year. So why should we invest more and the return is low? That's what I don't get.
Can you control returns? So let's build a point. Can you control returns?
No, sir.
No.
Yeah. Okay, so because you can't control returns, there are times when you invest more and the returns will be lower. Or there are times that you invest less and the returns will be higher. Do we agree on that? That we can't control returns. Okay, but in this particular example, what I'm saying is that, so let's look at it again. If you go back to the data that we have, okay, how much did we invest in the first year? How much?
50.
Yeah, so initially we bought one stock at $50, okay? So we had only one stock. Then in year 2, we bought an additional stock. Are you following?
Yes, sir.
What's our total investment in year 2?
100 and
103.
Yes.
53. Okay, so in the second year, we have more money invested than the first year. That's the point I'm making. Okay, in the second year, we've committed more money than the first year. Okay, but if you look at when we computed the returns per year, which is the time weighted return, the return in the first year was how much?
10%.
10%. And then what was the return in the second year?
5.66%.
Okay, so all I'm saying is that because we don't control returns, it's possible that in the first year we invest less and we actually have more returns, which is 10% for year one. And year two, we had 2 shares, not 1, but the returns were lower, 5.66%. Okay, so for example, if you take, the reason why I asked you the first question is that we don't control returns. If you take COVID-19, for example, I don't know, unless you were a financial god and you could predict, let's say, a year, in which case a lot of people will come and consult you and you make a lot of money. If you can tell the future with certainty, okay, then I don't think you even be in this class. It's a waste of time. Okay, if you could predict, and that's why I'm also here, because I can't tell returns with certainty. If I could, there's no point being here teaching you. I'll be in the stock market making a lot of money. And of course, even though we are joking about this ties in the concept of, I'm sure you discussed efficient markets with Ben. We did talk about efficient markets hypothesis. I'm sure when I leave here, and somebody asks you, did you do the risk and return? Oh no, we didn't do it. We don't remember. Give me a moment. Let me see. So I'm sure Ben covered efficient markets with you. Anyway, efficient markets are, when markets are efficient, it means that security prices reflect all available information, and consequently, it's difficult to outperform the market. So that's important to know and understand. Okay, so when markets are efficient, okay, it means that security prices reflect all available information. So it's not like there's information that has not been incorporated into stock prices that you can use to make higher than average returns. So 2 things. One, if stock markets are efficient, let's use stocks as our financial instruments. Then stock prices reflect all available information. Is that okay? Stock prices reflect all available information. And that when new information comes to the market, stock prices will react quickly to incorporate that information. Okay, we don't see that a lot in our markets in Ghana and to a large extent Africa, but elsewhere, if a company announces something today that they've made a breakthrough of they've developed a new product, that same day you see that the market will react, or the company's stock price will go up. Okay, that same day, the company's stock price will react. Sometimes, and it's very funny, the company announces earnings, but its stock price falls. Or the company announces an increase in earnings, but its stock price falls. Right? Why do you think that may be the case? Any idea? Why may that be the case? Sadiq.
I think they maybe from past experience or from past history of the company, they wouldn't really don't budge or put money in their stocks because of the past events.
Not necessarily. So that when when the company announces an increase in earnings and the company stock price falls, typically is because even though the earnings have increased, the market expected the company to do better. So it's like you underperform. Let me give you a typical example. So let's say when you are in JHS or SHS, okay? You can be the third in class. Okay, let me not use University of Ghana. You can be ranked number 3 and you'll be very unhappy, right? It's because people don't expect number 3 from you. They expect you to be number 1. Are you following? So a company can announce, oh, we made profits, and you see that the stock price will fall. And the reason is that the market is expressing its disappointment, okay, because they expected the company to do better. So sometimes it's very interesting. You see that, oh, the company has announced earnings, but the stock price falls. Okay. So basically, that's efficient market hypothesis that stock prices follow a random walk. When we say they follow a random walk, it means that we can't predict stock prices. So they are random. And why are stock prices random? They are random because the news that is going to affect the price of the stock tomorrow, we don't know that news today. So the news is random tomorrow, and therefore the prices will be random as well tomorrow. Am I making sense? So we are saying that the price of the company's stock tomorrow will be affected by the news that is going to occur tomorrow. And because we don't know the news that will happen tomorrow, then by implication, the prices of the stock tomorrow we also cannot tell. I.e., those prices will be what? Random. Okay, i.e., those prices will be random. So basically, that's the main idea of efficient markets hypothesis. Stock prices you cannot predict. If we could predict stock prices, a lot of people will make money because you know which stocks to buy, which stocks to sell. Okay, but we can't. It's a very difficult art. And indeed, very few people are able to beat the market on a consistent basis. So there are a lot of important things we are discussing today. Okay, there are investment instruments called, I don't know, did I show you exchange traded funds last week? ETFs, I believe I did. Okay, you know why they develop ETFs? The main reason is that if I give my money to somebody like Data Bank to manage my money for me, and I'm going to pay them a management fee, usually about 3% a year, why should you pay somebody who cannot on a consistent basis even give you returns higher than the GSE return? I don't know if I'm making sense. So in our environment, it may be difficult to appreciate, but what I'm saying is that elsewhere, like I showed you last week, you can buy the market, you can buy the S&P 500 with just $500, or you can buy the Australian stock market with just $500, or sometimes even lower. Okay, so if I can buy the entire market and earn, just a moment, I'll show you, and the market returns, why should I give my money to somebody and then that person cannot even give me the market returns consistently? They can't even outperform the market. Do you get what we are saying? Guys. Hey, you had to. Okay, what we are saying is that, let me see if I can. Okay, let me see if I can get to market returns. Just a moment. So. Okay, so I found something for you. Let's look at it. Okay, so that's the S&P 500. Okay, and these are the returns. So look at the return in 2019. What was it?
31.29%.
31.29%.
9%.
Okay, 208. This was.
Negative 36.97.
What happened here?
It dropped.
Why? Which
Recession.
event is it?
Recession.
Global financial crisis. Okay. So what I'm saying is that, let's say 2018. No, let's make it 2020. Okay. This was a market return, 18.25%. You can take a fund that manages money for people and compare their return to the market average. Okay. Typically, what you find is that the funds are not able to generate a return higher than this market average consistently. So there may be a few years that they outperform. When the market is 18.25, maybe they'll get 20. But there are also years when the market is 18.25, they'll get, let's say, 15 or 16. Okay. So the idea behind an ETF is that, why should I pay somebody money to more or less manage my money for me on an active basis, but they can't give me a return consistently greater than the market return? Why the market return is what we call a passive portfolio. Okay, you can buy. So I know this may sound strange to you, but you can buy the market and do nothing. Let me show you. We can buy, you can pretend to buy. Okay, you can buy the market and do nothing and earn the market return. Does it sound strange? Okay, I can decide to buy the Australian market, come here and say buy. So when I buy this ETF, okay, this is an exchange traded fund, more or less, the return that I'm going to get from this investment will be, so let's say 20, let's go back here. 2020, I'll get about 18.25%. Okay? Because the fund is constructed to replicate the performance of what? Sorry, my video is still off. The fund is constructed to replicate the performance of the market. When I read your facial expressions, I'm not encouraged. Okay, it's very easy. Just let's look at it this way. If you take Ghana Stock Exchange, okay, unfortunately, we don't have a fund like that in Ghana. But if there was an ETF constructed on the Ghana Stock Exchange, all they need to do is to more or less, their fund will hold the shares on the GSE just like it is on the GSE. Okay, so if EcoBank is 10% of the market capitalization, they'll own 10% of EcoBank. If CarBank is 5%, if they have 1,000 CDs, they'll use 5% of that money to buy CarBank. Okay, so at the end of the year, the return on the fund will be similar to the return on the market. I.e., if the GSE posts 12%, the return on our fund will be about how much? 12%. Okay, so the money is not actively managed, i.e., the manager is not buying and selling shares. Do you get me? They just construct the portfolio to look like the market, to replicate or give the market returns. This one, can you explain it? What have we said?
Say please, with the buying and gaining returns from investment? Is it that normally we don't have a choice of, That's why we invest in most of the companies, because some of them don't make any better returns on our investments.
I thought you're asking a new question altogether.
Yes, I wanted to ask this question long ago, but
Okay, what's your question again?
say with the investment managers, like those we invest with them, like Data Bank and other investment company, sometimes they don't make huge returns on our investment, but as if we don't have any option than to invest with them, because the little they give us, we accept that. But look, comparing with other stock markets, maybe outside the country, they are doing better.
Not necessarily. I wouldn't entirely agree with that. There are years that the GSE performs better than other stock markets. In the past few years, yes, the GSE hasn't performed very well, but historically there have been years where, and even they say it has done well. Okay, so it's not a general conclusion I would make. There are years in which it performs better than other markets. But more generally to your point, I believe if you're a fund manager, you understand that it's not easy to generate. It's not. We don't have anything like a money machine. That Charlie, you can invest and print 100% returns in a year. Okay, it's very hard to come by. So yes, there are a couple of factors why funds in Ghana don't do well. There are so many. Maybe the managers are not well trained, or they are not very qualified. The investment opportunities in Ghana are few. Even if you are well qualified, we don't have a lot of investment options in the market. Our stock exchange doesn't have more than 40 listed companies. Elsewhere, you have the option to choose between 5,000, 10,000 companies. Here, your choice is limited. Okay, so there are a couple of factors that explain. Again, remember that the performance of the stock market depends on the performance of the economy. So if the economy is not doing well, even if you are a star manager, your performance is in a way tied to the performance of the general economy. Okay, so there are numerous reasons why sometimes funds in Ghana don't do well. Okay, but the general point I was making is that if you buy an ETF, let me see if I can show you. The management fees are typically very low. Yes. Got a management fee. What do you see?
0.07%.
0.07%. There's not 1%. Do you know what this figure is? 0.01 is 1%. That's 0.07%. Okay, so this is not even. It's not even 0.5. It's not 0.5. It's less than half of a percent. It's less than 1/10 of a percent. Okay, so the management fees for these funds are very low, and like I was telling you, Leonie, like I was telling you, the reason why this management fee is low is that this fund is not an actively managed fund. Okay, the fund is constructed to, if they say AXS 200, for simplicity's sake, say the fund will buy all the 200 shares listed on the Australian Stock Exchange. Okay, so they just buy all the 200 shares listed on the Australian Stock Exchange. And what return should you expect? The return on the Australian Stock Exchange, right? Because we are buying the entire market. Leonie, what did I say? You are my marker, so what did I say?
I'm actually lost. That's why my facial expressions are like that.
No, this is very simple. This is extremely simple. I don't know how to explain. See, if you are, let's say your market is jollof, how do you cook jollof?
Hey, we cook it in different ways. I'm not Ghanaian, so we have our own method of cooking.
I mean, what do you put into jollof?
You use tomatoes, you use oil, you use
tomatoes,
spices, we use
oil,
carrots,
you use
use
carrots, you use
rice.
rice. Okay, everything. Imagine that everything that you throw into jollof is our shares, and the jollof is your market.
Okay.
Are you following? So jollof is a stock market, i.e., the Australian 200 index. So it contains 200 shares. So it
Okay.
contains onions, tomatoes, pepper, rice, garlic. Everything is a market. So if you buy the market, you get standard jollof. Okay?
Yes, sir.
So that's what I'm saying. If you buy the market, our standard jollof here is 2020. How much?
18.25.
20.25. You didn't try to make your jollof any special jollof, try to change the formula, add some additional ingredients or take out some ingredients to get better jollof or Nigerian jollof. No. Okay. You start to the plain formula, let's say the vanilla formula. So what we are saying here is that if the stock market in Ghana has 40 shares, you buy all the 40 shares. Okay. And if you buy all the 40 shares, what should be the return you should expect?
18.25.
18.25.
18.25. Okay. You buy the market, you get the market returns. So if you buy ASX 200, you get 18.25 2020. That's an ETF. And it's passive because, like I said, they are not making any extra effort to give you any superb returns. So when I say making extra effort, okay, you say, okay, maybe the jollof, when you take out garlic, it tastes better. Okay. Or when you add your secret sauce that people usually don't add, it makes the jollof taste better. So here, when you are buying a fund, you are trying to create your own jollof.
Mm-hmm.
So if you give your money to data bank, manage for you, they are not giving you the standard jollof. You are paying them to give you superb jollof. Okay. But the research shows that when you pay data bank to give you superb jollof, in 2020, when the market gives you 18.25, they give you 15. So why would you continue to pay them? Do you understand the point? Okay. So if you want the market returns, you can just, if it's 200 shares in the market, buy all the 200 shares. In Ghana, we have about 40, buy all the 40 shares. And you will get an average market return. Okay. If you give your money to somebody like Data Bank, you don't want 18.25. You want maybe 24 when the market does 18.25. Why do you want them to do 24, for example? Because you want them to, if they claim to be investment professionals, they should be able to tell the stocks that will do well, right?
Yes.
And buy those shares. And they should be able to sell the shares that won't do well, such that they should produce a return higher than the standard jollof or the market return. Okay. But practically what we see is that we give money to, I don't know if I can, I don't take too much time. But you can compare the returns. Take Data Bank's EPAC, for example. Okay, you can compare to the GSE market return and see. There are years that the returns that EPAC gives are lower than the GSE market returns. Okay, which tells us that it's difficult for these guys to outperform the market. And that's the central message of the efficient market hypothesis. And that's the central message of the efficient market hypothesis. So maybe, which example can I give you? Okay, so that's an example that I usually give. Okay, making money in the stock market is like earning dollars or earning CDs, right? Now, assume that I took you out for lunch, and on our way to lunch, we see $100 bill on the floor. Will you try to pick it?
No.
Why not?
Principles.
I'll pick it. So
I'll pick it. Sir.
Okay, you're not a normal. Let me ask Bismarck. Bismarck, will you pick the money?
yes, sir, I'll pick it.
Okay. You know what the efficient market hypothesis tells us? It tells us that if you think you spotted an opportunity, i.e., the example I gave you, we are going out for lunch, and you see a lot of money lying on the floor, maybe you shouldn't bother, because if it was actually real money, are we the only ones who were passing that road? Do you get the analogy? If there's 100, especially on Legon campus, imagine you are going for lunch, Legon campus, and there's like $1,000 lying on the floor. How do you have picked that money long ago? It should be lying down there waiting for you to come and pick. Okay? So the central message of efficient markets is that there are so many analysts in the market, highly trained, with huge capital, looking for investment opportunities. Okay, and sometimes they pick these opportunities quickly when these opportunities come up. So if you think you've seen an investment opportunity, think twice. Money doesn't usually lie around for you to come and pick. Okay, money doesn't usually lie around for you to come and pick. In some markets, there are over 20,000 people analyzing one stock. What would the 20,000 people miss that only you will spot and make money out of? Okay, there are 20,000 investors following one share, analyzing it intensively. What have they missed that only you will spot out and make money from? Okay, that's the central message of efficient market hypothesis, that it's difficult for even professional money managers like Data Bank to produce returns that exceed standard jollof or the market return. Okay, so basically that's what I mean. Leonie, can you give me a summary, quick one?
So before giving the summary, I want to say something. Like, some of these agencies always claim that they have extra information that the market doesn't have. So how can these claims be backed up? Or how can you said you should think twice. So if you're the investor or you're someone who wants to let them do it for you, how do you, I don't know, check if whatever they are saying is correct, or just?
Can you check? You can't check, really. You see,
So you
before you
just,
buy a fund, you can look at past performance.
okay.
You can look at past performance. But even past performance is not a guarantee of what? Future performance. So maybe, yes, one way you can check is that you can look at past performance. Have they done well in the past? But that doesn't guarantee they'll do well in the future.
Okay.
And a good example is Ghana Black Stars. Well, maybe they used to do well in the past, won 4 African titles, but since 1982, what have they won? Even my soccer boots, they haven't won. Okay, so past performance is not a guarantee of future performance. So yes, you want to invest in a fund, you can look at their past performance, but that doesn't guarantee they'll do well in the future.
Okay. If you're looking at past, If you're looking at past performance, looking at these Ponzi schemes, they come and
Let's
tell
do
you,
Let's
they
do
tell
one more.
you this person did this and this is what they got. It's a sure investment platform. You should invest. They show you real data, or I don't know, to prove, like, just to back up their points, like the thing is a good deal. So if we have to follow the past performance appraisal, how do you, is that not
Remember
going to
last week when I said, if you are not sure about the investment, what should you do? Pardon?
So, yes, sir.
Check. If somebody is selling tomatoes, what do you think they'll tell you? Tell you that tomatoes is the best tomatoes in the world. But you are the buyer. Buyer beware. So you need to be sure that when you are putting your money, is a good investment. And again, I told you last week that I'm very uncomfortable when people are promoting very high returns. You should know that. Okay. If you're a finance person and somebody came to tell you that they made 80% in 2020, be very cautious. What was the market return in 2020?
18.2.
What did that person do to get 80%? It doesn't add up. Okay. If you look for the Ghana Stock Exchange returns, they are there. I'm not sure what they did last year. I think was a bit low. So if somebody is selling you very high returns, please be extremely cautious. And you should check. And again, I remember I told you last week that when someone is promising you high returns, they are promising you extremely high risk as well. So be extremely cautious and check what are the market returns. If equities are doing this GSC or share, give me a moment. Okay, let's look at the index performance. Okay, so year to date is about, oh wow, let's go. That's about 42%. Financial sources 8 points. So I told you this year is done well. Okay. But you can look at the historical returns. If GSC is doing 10% and the guy is promising you 80%, run for your life. It's not possible. And which information do they have that nobody else has? And if indeed they have information that no one else has, it's probably problematic. They're probably using insider information, which is illegal. Okay, if a fund is trading based on information that nobody else has, that is illegal. If they are caught, they will go to jail. So the way stock markets work is that information is given at the same time, so that no investor has an advantage over the other. So if you look at it, there are press releases. Oh, the company will come out and do a press release. We've paid dividend. It's here. Everybody can tell. Or this way our earnings. Everybody can tell. And the information goes out at the same time. Okay. So if somebody comes to tell you I have information that nobody else has, where did they get it from? Who gave them that information? It's probably illegal information. Okay, so as people who have sat in a finance class, be extremely cautious. High returns equate high risk. Okay, there's nothing like a money machine. I know this is a common problem because human beings are greedy. We want more money. But where is the person going to get the money from? So guys, please be cautious. And don't fall for the company being promoted by celebrities. Don't fall for the company being on the radio. be very careful. Okay, extremely cautious. So let me tell you, my dad was a judge, and he invested in some company. Yeah, I didn't even know. He only told me after he had invested. So the guy trying to fish farm me. they are making so much money. Charlie, the guy, fish farming so much money. That rings immediately rings alarm bells in my head. Red flag, red flag, red flag, red flag. So like we didn't talk about it again. Yeah, I mean I don't believe. Oh, the guy is always on radio convincing people like yeah, I don't believe. Sometime back I went to him and he started laughing. Hey, I said it too. The guy has run away with his money. So please, these guys can be convincing. Or number one, you see Shatta Wale dancing and Emmanuel Penam one. You see Kumi guitar saying, please be cautious. You see, I don't know how to put it. If the standard fans don't do this, are you seeing data bank advertising so much with celebrities? No, the standard fans don't do this because there are regulations that govern their activities. Okay, so Johnny, be careful. Somebody tells me I have information nobody else has, red flag. Okay, what kind of information? Who gave it to them? Is it from the Bank of Ghana that who? The president? What kind of information? Is it cabinet level classified data that nobody else has? Yeah, where's Mike?
Yes, sir. Sir, please, I have two questions. Wait, with the first one, how come data bank would give you lesser than the market return? And also, last week you mentioned about the lifespan of the Ponzi schemes. So please, if you could repeat that one for me. Thank you.
Okay, so we are running out of time, so I'll just take your first question. Okay, so a fund can underperform and they can outperform. Okay, one, remember that they hire analysts. Those analysts are paid. So there's a huge operational cost. If you are hiring a CFA holder to manage your fund for you, you're going to pay him some money. Okay. In trying to beat market returns, they buy and sell. Buy and sell. Anytime you buy and sell, what do you generate? Transaction costs, brokerage fees, commissions, levies. Because anytime you trade, you pay commissions and fees and levies. Okay. So funds that are actively managed, one of the reasons why they underperform the market is that one, they have high operational costs. As you saw, ETFs have very minimal management fee. Two, they generate a lot of commissions through buying and selling. So yes, they can do maybe well, but that performance will be eroded by commissions and fees, operational expenses. And of course, they may select bad stocks. Okay. They may select bad stocks that won't do well. You see, when you buy the market, you can go to bed. Some of the stocks will perform well, but some will perform poorly. But at the end of the day, if you had bought the S&P 500, what was the return? 18.25. Does it make sense?
Yes, sir.
So key reasons: operational cost, transaction fees, selection of bad stocks. Okay, I saw another hand up. Can you raise your hand again? Let me take one last question, then we will continue with the main business for today. So later.
Yeah, so I wanted to know, is it that we don't have bodies who regulate these people, their activities, and who, check them, so that if maybe to see how the market is, so in case of cheating, that we can at least do something about it before it gets out of hand.
Well, I guess you know the answer. There are regulators in the market. Okay, so there's the Bank of Ghana, which regulates the banking system.
But is it that maybe they're not doing their work well, or why sometimes we have these issues concerning the stock exchange and then?
Well, you see, you also have a role to play. You should also know that in particular, in the case of what did they call it? Men's gold. The investors were warned. There were several warnings. Don't invest in men's gold. I said, no, we will invest. We trust him. He is doing gold. Okay. So, yes, the regulators have a role to play. Okay. Of course, sometimes they don't always do a good job. If somebody opens something in Dodo, but how would the regulator know? They may not know. So you will have to report it like, hey, this fund, I don't think is genuine. I think you should follow up. Okay, so it's a shared responsibility. And that's why financial literacy is key. So I'm not saying that they're not totally to blame. Sometimes they don't do their work well, admittedly. But sometimes they still want investors, and investors go ahead and engage in some of these activities. But you see, what I always tell people is that if you invest in a company licensed by the Securities and Exchange Commission, or if you invest in a bank licensed by the Bank of Ghana, and the bank collapses, you have some implicit protection. Okay? What's that protection? When the banks collapse, what does the government do? Let's see, what does the government do? We can't hear you, you're on mute. Hello. We still can't hear you, you're on mute. Okay, so if you invest in something that is licensed, if you take the BOG when the banks collapse, the government came in to give depositors their money. Same thing for the fund managers that collapse. And in a way, that shows that the government accepts that they also to a way failed, or to a certain extent failed, because they are supposed to regulate. So if they are not regulating these companies' wealth and these companies fail, they have a moral obligation to compensate investors. But if you invest in men's gold, nobody is going to compensate you. Who licenses men's gold? Nobody. It's not licensed by the Bank of Ghana, not licensed by SEC. SEC one investors stay away. Bank of Ghana one investors stay away. They didn't. In such a case, nobody is going to compensate you. Okay. So investing in a licensed entity is important. It doesn't mean that entity won't collapse, businesses collapse every time. But you have some protection if you invest in a licensed company than if you go invest in somebody comes and say we are, I don't know, some crazy scheme. And usually when you advise people not to do it, they think you don't like them. Or so people come and tell me, no, this one I don't think is good. They don't come back to me again. They're going to do what they will do. And then they will lose their money. Anyways. Okay, so let's go on quickly. I think let's go to the main business for the day. So we talked about dollar-weighted returns. We also talked about the time-weighted returns. We saw how to find that. And let's talk about variance. Variance is a standard deviation. Okay, so this is how to find the variance of an asset. Okay, so this is actually very simple. Let's implement it. So when I say variance, okay, is the deviation from the expected return. So variance standard deviation is what did we expect the return to be? What is the actual return? Very simple things. What did we expect the return to be? And what is the actual return? So last week, if you remember, we found the arithmetic return to be how much? Do you remember? 8%. We added 8% by 5. Okay. So it means the expected return is 8%. But let's look at the return in year one. What was the return in year one?
10%.
10%. But what did we expect in year one?
8%.
8. So this all variance is. Okay, don't forget about the statistical variance is that, hey, we expected a return of 8, but in year one, the return was 10. So there's a positive deviation or a positive surprise of 2. That's your variance. Simple. Okay, so we expected the average return is 8. In year one, it was 10. So there's a positive surprise of 2. So write that down, 2. We'll do something very soon. What was the return in year 2? 30.
30%.
What did we expect it to be?
8%.
So what is the variance? It's 22.
22.
Okay, there's a positive surprise of 22. More than we expected. It's like somebody said, I'll give you $8. And then they ended up giving you $30. You'll be happy, right? Because they give you an additional $22. Basically, that's what we have in year 2. What about year 3? What's the variance? What's the deviation?
Negative 20.
Negative 28. Because we expected 8. We didn't get the 8. And then we lost an additional 20. Okay, so the deviation of the surprise for year 3 is minus 28. Does it make sense? You expected 8 positive. You didn't get it. You lost that 8. And in addition, you lost 20. Okay, so the deviation for year 3 is minus 28. What about year 4? What's the surprise?
Nothing, 0.
No, it's not 0. What did we expect? We expected 8.
8.
What did we get?
0. So you have 8%.
It should be minus 8.
Plus 8. Minus 8.
Okay, minus 8. It's like somebody said they'll give you $8. And then they didn't give you anything. So what's your loss? You lost $8, right? Okay, so our expected return in year 4 was $8. We didn't get it. We got 0. So it's like there's a loss of 8. So the surprise is minus 8. What about year 5? What's the surprise?
12.
It's 12.
Yeah, 12.
We expected 8. We got 20. So think about it this way. Somebody said they'll give you, your uncle said they'll give you let's say $8,000 at the end of the year. And then for some reason, at the end of the year, he give you how much? $20,000. Won't you be happy? He surprised you with how much? An additional $12,000. That's what we are saying. Does it make sense?
Yes, sir.
Okay, so if you take year 3, somebody promised you $8,000, they didn't give you. Rather, they came to take $20,000 from. So it's like you've lost $28,000. So think about the deviation like that. What is the actual return? What was the expected return? And what's the difference between the two? That's your deviation from the average return. And that's your deviation from the expected return. Okay? So it's extremely simple. Don't think about this as math. This is not math. This is practicalities. Sonny said they'll give you $20,000. Sorry, $8,000. At the end of the year, they give you $20,000. They surprise you with $12,000. That's your deviation. Okay. Again, if you take year 2, the guy promised you $8,000, let's say for your birthday, and then he gave you $30,000. The $8,000 you were expecting, so that's not a surprise, right? But the additional $22,000 is a surprise. It's a deviation from what you expected. Again, if you take year 4, the guy promised you $8,000 for your birthday. Your birthday, he came and said, "Oh, you know what? Something happened at the office, so let's make it next year." In essence, you've lost $8,000, isn't it? You were expecting $8,000 and you got nothing. So it's like you lost $8,000. That is the concept of the deviation from the mean return. And that is what we use to find the standard deviation. Ladies and gents. Yeah, where's my?
Say, but why would you lose 20%, whereby you were promised 8%, and even that 8% you are not getting it?
So remember the question I asked? I asked Leonie, can you control returns?
No, sir, we can't.
Then that's your answer.
Thank you, sir.
Okay, because if you look at this, 2018, what was the return?
Negative 4.45%.
208, what was the return?
Negative 36.97%.
208, what was the return?
Negative 22.12.
So that's your answer. Okay. When investors invest in the market or the stock market, on the average, they expect a positive return, but the return is not always positive. Okay, there are actually years where we can lose money because we can't control returns. Okay, there are years that we can lose money. Okay, so let's do this quickly. Let's do something quickly.
Excuse me. Say.
Please hold on. I haven't called you yet. Okay, so let's the deviations from the mean return. So yeah, one was minus 2. What's minus 2 plus minus 22? Minus 2 plus 22. I ask you to write this down. So yeah, one was 2. Okay, so 2 plus 22. What is the answer?
24.
What's 24 plus minus 28?
4.
What is?
No, negative 4.
That's negative 4. What's negative 4 plus negative 8?
Negative 12.
What's 12 plus 12?
24.
No. Negative 12 plus 12.
0.
0.
0. So all I'm saying to you is that first of all, we find the deviation from the mean return. Okay. And now I'm answering the question why we square. But if we don't square, positive and negatives will sum to what?
0.
0. Okay, so that explains why we square the deviations. Okay, that explains why we square the deviations. So you sum the squared deviations and divide by n. The answer you get is called the variance. And the standard deviation of the variance is the square root of the variance is the standard deviation. Okay, the square root of the variance is the standard deviation. So Priscilla, I'll come back to you in a second. Let me summarize. What I'm saying is that first of all, the concept of standard deviation or variance is that we are looking at the expected return from investing in the market and comparing it to the actual return in each particular year. Okay, so if on the average, if you invest in the stock market, we expect 8%. It means that as an investor, before you invest in the market, at the back of your mind, at least you're expecting to get how much? 8%. Okay, but the year one we didn't get 8, we got 10, so that's good. We are happy, right? And our surprise is positive 2. Year 2, we didn't get 8. Again, we are happy. We got an additional 22. What about year 3? We're expecting 8. We didn't get it. So it's like we lost the 8, came to 0, and lost an additional 20. So your surprise is minus 28. Okay. Year 4, again, you're expecting 8. You didn't get 8. You got 0. So your surprise is minus 8. And year 5, we're expecting $8,000. The guy gives you, or the lady gives you $20,000. You're happy. You get an additional $12,000 surprise. So that's the concept of the standard deviation or the variance. How far are we from the expected return? basically. Okay, how far are we from the expected returns? Meaning that if your variance is very high or your standard deviation is very high, it means the risk of the asset is high. Okay? If your variance is very high or your standard deviation is very high, it means the risk of the asset is high. Why? Because there's a higher likelihood that the returns will be different from what you expect. Am I making sense? There's a higher likelihood that the returns will be very different from what you expect. Okay, first line. Let me take yours quickly.
So I have two questions. The first one borders on, I wanted to ask you about the stock market. Yes, that if you lose money, are you losing the entire money, or the 8% promised interest is what you are losing? Or we are talking about the principal here in this case?
No, it's not just a principal. The way investments work is that your money goes up and down. So it's 12% on your total. So if your money is increasing, your total money increases by 12%. If your money is falling, your money falls, profit plus principal falls by, let's say, 20%.
All right. And please, the squaring the figures, the calculations part, I didn't get the second part where you have to square it. I really didn't get that part well.
Okay, so what I said is that we square because if you don't square and you add the deviations, they sum to 0. Okay, so when you go back, you can do that. We did it right now, 2 plus 22 plus minus 28 plus minus 8 plus 12. If you sum that, you get 0. Okay, so the point is that if you sum the surprises, so like I said, the concept of the standard deviation is look at the deviations from the mean return. When you take this difference, it's the deviation. But the importance of squaring is that if you don't square and you sum the deviations, they usually add to 0 because you have positive and negative deviations. Do you get it? So we square the negatives to make them positive, so that when we sum, we don't get 0. Okay, so you can do it. What's 2 plus 22? Very quickly. What's 2 plus 22?
2 plus 22 is 24.
What's 24 plus minus 28?
That's minus 4.
What's minus 4 plus minus 8?
Minus 4 plus minus 8, that's 12.
Minus 12.
Yes, minus 12.
Minus 4 minus 8 is minus 12. What's minus 12 plus 12?
Yes. That's 0.
Okay, so yeah, that is why we need to square. Okay, so we square to like 0. Okay, you're welcome. Let's progress quickly. There are a few things I need to explain. It looks like I can't do portfolio theory, but at least let's finish expected returns and expected risk. So what we've discussed so far are historical returns and historical risk, but sometimes we are confronted with expected returns and expected risk, in the sense that we are not talking about historical returns. We are talking about, okay, I'm going to invest. What am I going to get in the future? That's expected, right? And because it's expected, we don't know those returns with certainty. Maybe Leonie knows because she's a financial god. but the rest of us mere mortals, I can't tell you what the return on MTN will be next year. Nobody knows. Okay? Or nobody can tell you what the return of, let's say, Cowbank will be next year. Or what will be the return on oil prices. Or what will be the return on gold. Or what will be the return on cryptocurrency. Nobody knows. By their nature, investment returns are uncertain. Okay? So if you're talking about future returns, we don't know those returns with certainty. And therefore, we attach probabilities to those returns. Okay, or is maybe 80% likely that the return on cow bank next year will be 20%, or is 60% likely that the return on MTN will be 20% next year. We don't know. Okay, we can only attach what? Probabilities, because the returns are not known with what? Certainty. Okay, the returns are not known with certainty. Okay, so that is why we attach probabilities. And how do we find the expected return? We multiply the probability by the return, and then we sum. So this sigma sign indicates that we should do what? We should add, or we should sum. Okay, this sigma sign indicates that we should add, or we should sum. So let's take a quick example. Okay, before that, let's look at the expected variance. Do you understand this formula now? So this is the return in, let's say, year 1 or any particular year minus the expected return. So the expected return is, take it like our 8%. Okay. So what is in brackets here is called what? The deviation or the surprise. And then, Priscilla, do you understand why we square?
Yes, please, to avoid getting zero.
Exactly. But for expected risk, we multiply by what? The probability, because we don't know the returns with certainty. So there's a key difference between the historical variance, historical standard deviation, and the expected variance or the expected standard deviation. Here you will see probabilities. Okay, for the expected returns, expected standard deviation, you see probabilities. But when we go back and I show you the historical standard deviation, do you see any probability here? No. There's no probability associated with historical returns because those returns are known with certainty. If I ask you what the return in 2020 was for the S&P 500, what will you tell me? It was 18.25%.
18.25.
You know, and nobody tell me that there's a 20% probability that it will be 18.25. No. Historical returns we know with certainty. So that's why there's no probability. So, okay, that's why there's no probability here. And there's another difference. We divide by n minus 1. Okay, why do we divide by n minus 1? I don't want to go too much into statistics, but it's to adjust for what we call the degrees of freedom, i.e., the expected return itself is estimated. Okay, so that is why we divide by, usually you divide by n, but n minus 1 to adjust for the loss of the degrees of freedom. Okay, so we also divide by n minus 1. Usually there's a formula you should use. Okay, so not by, you don't divide by n, you only divide by n if you have population returns. If you have sample returns, then you divide by n minus 1. Okay, so another difference between that and the expected risks is here we don't divide by n minus 1. Okay, so for the expected standard deviation or the expected variance, we don't divide by 1, n minus 1. Okay, but for the historical, we divide by n minus 1, and historical doesn't have probabilities because the returns are known with certainty. But this one has probabilities, the expected, because we don't know the returns with certainty. Is that okay? Okay, and there's another hand up. Erasmus.
So I wanted to find out how the probability is determined that with the expected returns and risk.
Well, for the probability is probability is every analyst will come up with a different probability. I don't think there's a formula. So probability is the likelihood or chance.
Yeah. So I wanted to know why we would maybe the probability would be maybe 50% or maybe a 30% or maybe like a 10%. Like
that is based on there's no formula for that. Okay, it's based on your own intuition, based on So if you're an analyst, okay, you will come up with your own probabilities. The only guide, for example, if we look at this data, the next example we are going to do, okay, you can say, okay, out of 100 years, okay, so look at something, out of 100 years, 20 years, the economy was growing fast. 60 years, the economy was normal. Another 20 years, we had a recession. So you can use something like this. Okay, but the fact, even these ones are not predictive of the future. Okay, so you will have to use your own estimation and say, okay, I think that the probability of a recession won't be like in the past. Okay, remember that in investments, yes, the past is a good guide, but it's not a guarantee of the future. Okay.
Okay, sir.
So there's no formula to it. Sometimes you can just, okay, maybe if I look at the entire economy, 20% of the time, there's a recession. So I'm going to attach recessions with a probability of 20%. Okay, but it's based on your own, and these are things that you develop as an analyst as you progress. Okay, so there's no objective formula. The probabilities that is used by, let's say, data bank may be different from what is used by Tesla Capital. It will probably be different from what is used by another investment firm. Okay, what we call heterogeneous expectations. We all don't have the same expectation. So sometimes somebody asks me, okay, why is somebody buying a stock and why is somebody selling the stock? What will be your answer? Why is somebody buying the same stock and why is somebody selling the same stock? Heterogeneous expectations. Okay, maybe, so if you are looking at even, I don't want us to go into derivatives, but if somebody is buying a call option, they are buying a call option because they think the stock price will go up. Or they are buying the shares because they think the stock price will go up. But the person writing the call option is writing the option because they think the price will go down. So we all don't see things the same way. Do you understand? So I gave a previous class a funny example. Do you know that if you divorce your wife today, somebody will marry her? Or if you divorce your husband today, what you think is not good, nobody will like. Somebody will come and buy. It's the same thing in the stock market. What you think is not a good stock, somebody, hey, this is the best stock you have seen in the world. Okay. So because of those expectations, we have constant demand and supply. It's actually very dangerous if everybody's at the same side of the market. If everybody is selling, the stock market is going to collapse. If everybody is buying, there's going to be what we call a bubble. Again, the stock price will collapse. Okay. So the guy who has the question, there's no formula for this. You can look at the past as a guide, but like I said, even the past doesn't guarantee the future. Okay, guys, let's do this question quickly. So let's find the expected return. So it's 20%, there's a probability times the return in a growing economy. Okay, so we are finding the expected return. So 20% times 35%, that's what you have here, plus 60% times 20%. So let's go back. Probability of a normal economy is 60%. Multiply that by how much? 20%. Okay, that's what you have here. Plus, let's go back. Probability of a recession is 20%. What's the expected return? 10%. Okay, and that gives us the expected return to be 21%. What about the variance or the standard deviation? So again, remember RI minus expected return. What's our expected return in this example? 21%. Okay, we just found that. So what is RI? So yeah, the first one is 35 minus 21. So in the scenario of a growing economy, it's 35% minus 21%. And then what do?
You score.
Square. But because these are expected returns, we also then multiply by what?
Probability.
The probability of a growing economy. Okay, so there's a probability. Then let's go to the next one. What's the return in a normal economy? It's 20%. Okay, so 20% minus the expected return of 21%. Again, what do we do?
Square.
And then we multiply by the probability of a normal economy, which is given as 60%. Is that okay? Then finally, what's the return in a recession? Because in a recession, stocks don't do well. So let's say 10%. Okay. So you have 10 minus 21. What do? We square. And then because it's expected, we multiply by the probability of a recession, which is how much? 20%. Okay. Remember here, we don't divide by n minus 1. So you just add, what you get is the variance, and then you take the square root to get the standard deviation. Okay, you take the square root to get the standard deviation. Okay, Presley, I see your hand is up again.
Sorry, sir. I think it's the old one. Sorry.
Okay, sure. Sadiq.
Yeah. So my question here is the square root. Do you after you are done solving it one by one, do you do the square root? Do you do the power before you add it, or you do it at the end? Because the previous one like this, I didn't see the calculations of the power until the next step.
Which power?
You see, it's 0.20 into bracket 35 minus 21 raised to the power 2. 0.60. Okay, I think I get it now.
Before you multiply by the probability.
Yeah, I was asking if you you solve the squared before you get about, I think 64%.
No, you find this before you take the square root.
Okay.
If that's your question, you
Yeah.
find this, sum it. What you get is the variance.
Okay.
Okay, you only take the square root of the variance to get the standard deviation.
Okay.
Okay, it's the same thing with it. If you, let me take you back. What do you have? We added the square deviations. Here, because it's historic, we divided by n. What's 1480 over 4?
370.
And that's your variance. And now take the square root of 370.
19.2.
Okay, that will be your standard deviation. Okay, so you add the square deviations first to get the variance. But so I don't want to be too technical. The answer of the variance is percentage squared. Why is it percentage squared? Why? Because we squared it. You see, what did we do? What did we do?
We squared it.
We squared it. Okay. So the answer of the variance technically is percentage squared. But our returns expressed in percentage squared. No. Natural returns are in what?
Percentage.
Percentage. So that is why we take the square root of the variance to give us a percentage, to bring us back to a percentage. Okay. So technically your variance is in percentage squared, but it's only hey, my return is 10% squared. Well, what does that mean? It's percentage that we work with. So you take the square root of the variance to get to a percentage standard deviation. Was that your question?
Yes. Okay, I think I get it now. You see this one like this. You see, you did a 10 minus 8. That's true. Then squared. That's a 4. The 30 minus 8. 30 minus 8. That's a 22. Then you squared. That's a 484. Before you did the okay.
Yeah. Yeah. It's the same thing here. We square this before we multiply by the probability, and that'll give you this answer.
Okay.
121 minus 35 minus 21. Is that 14?
35 minus 21. 14.
Yeah, so square that and multiply by 0.2. Now I'll give you the 39.2.
Yes, 39.2.
Exactly. Okay, and then you go to the second one, do the same thing, same for the third one. And then you sum. When you sum, you get 64%. But as I said, it's actually 64% squared because the percentages have been squared. Okay? So to get a standard deviation, you take the square roots to get rid of the square and to bring you back to percentage.
Okay.
Does it make sense?
Yes, please. Thank you.
Okay. Yeah. What do I do now? our time. Okay, so there's something. Have you heard about correlation? Okay.
Sir. Yes, sir.
Okay. So of course, this is the first course. For some of you, this is the first course in finance. So I'll explain what correlation is. Okay, so correlation is how you if you are dating somebody, hopefully the two of you are highly correlated, right? Meaning that you vibe. If two assets are highly correlated, it's like you vibe. Okay, they move together, they have the same flow. Am I making sense? If two assets are highly correlated, it means they vibe, they have the same direction. So if A goes up, B goes up. Okay? But if they have a negative correlation, that means that if A falls, B goes up. Are you following? Negative. So one goes up, one goes down. But positive is that one goes up, the other goes up. Okay, that's the concept of correlation. Okay, so we have positive correlation, meaning that the two assets move together in the same direction. And we have negative correlation, which means that they move in opposite directions. Okay. So positive correlation means that they move together in the same direction. And negative correlation means that they move together, or they move in opposite directions. Okay, they move in opposite directions. So for example, I was showing the other class. Usually if you look at shares and bonds, they tend to have negative correlation. When the stock market is going up, bonds are usually going down and vice versa. Okay, so they tend to have a negative correlation. Or what else can I give you an example of? Okay, maybe oil prices. Okay, and even that one can be tricky. But give me a moment. Let me see if I can grab some data for you. This one. This is a low negative, it's a low positive correlation. Okay, so basically, like I was saying, correlation is how two assets move together. If it's positive, it means if A goes up, B goes up. If it's negative, if A goes up, B goes down. Basically, just look at correlation like that. Correl, how they correlate. Okay, so if you say you and somebody vibe, it's like, oh, you guys are highly correlated. What A is thinking, B is thinking. Okay, so positive correlation is move the same direction. Negative correlation is they move in opposite directions. Okay, so it's important to understand what correlation is. I won't worry you too much with the formula. Okay, but correlation is given as the covariance over the product of the standard deviations. Okay, so correlation is covariance over the product of the standard deviations. Okay, so correlation is the covariance over the product of the standard deviations. So what is the covariance? The covariance is just like the correlation. So how two assets move together, only that the correlation is standardized. Okay, when I say the correlation is standardized, the correlation ranges between -1 and +1. So the correlation is standardized. Covariance is not standardized. That's a key difference. Okay, so the correlation is standardized such that it ranges between -1 and +1. So typically in finance, we prefer to work with the correlation rather than the covariance. Okay, because the correlation is standardized and is ranging between -1 and +1. But what is the covariance? The covariance you should easily understand. Let me show you the formula. Okay, so covariance between asset I and J. So look at the formula carefully. Covariance between asset I and J. What is this first one? You know it. Return of asset I at time T minus the expected return of asset I. What is this? What is this?
Expected return.
No, this is a deviation. That's what we just did. Remember when you're finding variance standard deviation, this is what we do. The return of the asset minus the expected return. Do you remember?
Yes, sir.
Okay, so this is the deviation of asset I times RJT is the return of asset J at time T minus the expected return of asset J. And this is just what? What is this now? I just told you this one. What's the second part?
The deviation for J.
Deviation of asset J. Okay. So the covariance is just multiplying the deviation of asset 1 by asset 2, more or less. And that tells you how the two assets move together. Okay. In particular, if you look at this formula carefully, if we multiply the deviation of asset I by the deviation of asset I, what will we get? We're going to get RIT minus ERI squared because it will appear twice. Can you see that? And what is that? That's the variance. And if you take the standard deviation, that's the square root. Okay. So the covariance is similar to computing the variance for standard deviation, but because you say is covariance between two assets. Okay, it's covariance between two assets. So it's the deviation of the first asset times the deviation of the second asset, more or less. Okay, the deviation of the first asset times the deviation of the second asset. But intuitively, it tells you how the two assets move together. Okay, so there's an example here. I'll leave you to do it on your own. I really wish I could do it with you, but because of time. But we'll do the correlation. Let me show you the correlation. Let's do the correlation together. So you have asset returns. Okay, these are asset returns. This is asset HT. This the market returns. You can actually open this yourselves as well. So if you look at the slides, go to slide 122. This Excel icon. You can click on the Excel icon. It will open the Excel sheet for you. So go to slide 122. Click on the Excel icon. And then it will open the Excel sheet for you. Kasha, have you been able to open it?
On it, sir.
Sadiq.
It's opening.
Okay. Sadiq, have you been able to open?
It's open now, sir.
Okay. Leonie, have you been able to open? What
Yes,
about press line?
no, sir, not yet.
Not yet. Okay, so just open the slides. Go to slide 122. There's an Excel icon, and then just click on the Excel icon.
I clicked on it, but mine is not. It's
Then I can't help you.
I clicked it. It's still open. How are you?
Maybe if you're quick, what do you say they should do? You need to enable editing also.
Oh, okay, enable edit. Okay.
Yeah, they need to click enable edit.
Or your PowerPoint may be fake.
This is coming. It's coming.
In which case I can't help you.
It has come.
It has opened. Okay, so yeah,
Open,
just
yeah.
click on hello. Or somebody saying something.
No, please.
Okay. So when you click on the Excel icon, it will open the Excel sheet for you. So you see why it's important to ask questions in class. Those who ask questions, I know their names. So off the top of my head, I know Sadiq, I know Bismarck, I know Leonie, I know Leighton. Okay, I know who else. I know your class rep, and I know Priscilla. Okay, so it's good to really ask questions in class. Okay, so let's do, so you can, there's a sheet called correlations. Okay, you can click on that sheet. Then you see market returns. Okay, which is NKT. And you will see HT. So we are trying to find the correlation between HT and MKT. So you can delete what is there, 0.99, you can delete it. And then let's do it together. It's equal to Corel. So Corel is correlation. And it says we should select array 1. So we pick the returns of HT. Okay, then you do a comma. And then you pick the returns of the market. And then you close brackets and press enter. And that will give you the correlation of HT with the market. What does this mean? I told you that the correlation ranges between -1 and +1, right?
So
Okay, so when you have a correlation of 0.99, very high, that's almost perfect correlation. It means that if A goes up, or in this case, HT goes up, market also goes up. If market goes down, HT goes down, and you can see it here. When HT is -22, market is -13. Can you see?
yes, sir.
Okay, when market goes up 35, it goes up as well 29, 50, it goes up 43. So it's like they move almost in the same direction. And that's why the correlation is positive. And this is what we call a cyclical stock. Okay, a cyclical stock is a stock that behaves like the economy or the market. So for example, when the market is doing well, it does well. When the economy is doing well, it does well. So if you take something like airlines, okay, airlines are cyclical in the sense that you see when there's a crisis, people don't even have money to buy air tickets. Okay, so when the economy is not doing well, you see that airlines are not doing well. When the economy is doing well, airlines also do well. So it's called like cyclical stock because it moves in the same fashion as the general economy. Okay, cyclical. There are some that are called counter-cyclical, i.e., they move in the opposite direction of the economy. So let's do the correlation between stock CT and the market. So again, it's equal to Corel. Okay, and then you pick the returns of stock CT, comma, pick the returns of MKT, and then you press enter. And that will give you -0.99. What does this tell you? You see, when CT is up, market is down. Can you see it? When CT
Yes.
is down, market is up. CT is down, market is up. So I don't even need to compute the correlation to know that these two assets are negatively what? Correlated. Okay, because it's very clear. When one is up, the other is down. When the other is down, the other is up. Okay, so that's what we call a counter-cyclical stock, or an asset that moves in an opposite direction to the entire market. So for example, maybe food or some assets, even in a recession, people patronize food. Or education. Yes, education is a good one. For some reason, when there's a recession, people go to school. You know why? Bismarck, why? I think you were saying something about your mute.
No, sir, I don't know why. I'm ready
Are
to
you
learn.
working? Are you working?
No, sir.
And that's the answer. You see, especially when people lose their jobs, okay, there's a recession, I lost my job. What should I do in the meantime? Maybe I should go to school, right? Let me upgrade myself so that when the economy picks up again, I have new skill sets and I can get a better job. So this is a well-known fact that usually when there's a recession, we as business schools, we are happy because we get more business. People come and do their MBAs, or let me do an MBA. Let me not sit down in the house and waste the time. Okay, let me do something with my time, get an education, get a degree. Okay, so education is counter-cyclical. When the economy is not doing well, people tend to go to school more. Okay, so that's negative word correlation. Okay, so I think today we have to finish because today's our last class. So let's do. Can you stay for 10 minutes?
Yes, sir.
Yes, sir, that's fine.
Yes, sir.
Okay, so let me try and finish this quickly. My concern is, you see, if not for anything, I'll just say we should end. But because you're going to write exams with the weekend students as well, the same paper, I've got to be sure that you know as much as possible so that you can also do well on the exam. So let's go to portfolio theory very quickly. So portfolio theory is how do we construct an efficient portfolio? Okay, and basically, my battery. Basically, we are saying that the portfolio is efficient when the return of asset A is greater than or equal to the return of asset B, and the risk. So remember that the standard deviation is the risk. Okay, the standard deviation of asset A is less than the standard deviation of asset B. So don't worry too much about the formula. I'll explain it in intuitive ways for you to understand. All I'm saying is that for portfolio A to dominate B, its return should be greater than that of B, and its risk should be less than that of what B, more or less. Because we want more returns and less risk, right? We want more returns and less risk. So for portfolio A to be better than B, its return should be greater than or equal to the return of B, and its risk should be less than or equal to the risk of what B. But don't worry too much about the mass. Look at the implication here. If I give you portfolio A and C, which one should you choose? Portfolio A and C. So on your vertical axis, you have returns. On the horizontal axis, you have risk. Which one will you choose between A and C?
A.
Why will you choose C?
Because A has
Less risk.
the expected returns is high and the standard deviation is low. The standard deviation of return is low.
Okay, so I don't know who is talking. That's why I usually prefer you to raise your hand. So please raise your hand. Who is speaking? Lewis. Is your video on?
No, sir.
Okay. If you can't put it on, that's fine. You can continue. So please say it again.
Yeah, so I'm saying that the expected returns of A compared
Okay.
if you are looking at C, they are the same. So it should be equal, it should be greater or equal to. Then if you look at the standard deviation, the A is lesser than the C. So you go for A instead of C.
Okay, you go for A. Good one. Excellent. Okay. Why? You see, so remember that vertical is return and horizontal is risk. So what this really means is that asset A and C have the same level of return, but A has a lower risk. So we pick A. Does it make sense?
Yes, sir.
Guys, forget about finance. You guys know how to choose between things, don't you? You
Yes,
know, you know how to choose. Okay, let's say that you want to select between two girls. Everything is the same, but one has. I had a roommate who was very funny. He likes long hair. One has long hair. The only difference is long hair. And you go for the one with the long hair. Or everything is the same, but what don't you like? What don't you like? Give me an example. What don't you like? Maybe one doesn't go to church. So everything you mark them, everything is the same. But one doesn't go to church, and maybe you don't like that. Which one you pick? You pick the one that goes to church, right?
Sir, I like the non-church goer. I prefer the.
Well, I don't know. You see, a lot of the women they like people who go to church. But I get you. A lot of the churchgoers are even worse than the people who don't go to church. Okay, so the point we are making is that forget that you are sitting in a finance class. If you were to choose between two things, how will you choose? A and B give you the same level of satisfaction or the same level of return. But A has lower risk. And as investors, we like risk. No. So which one do you choose? You choose A. It's as simple as that. Okay, you choose A because for the same level of return, A gives you lower risk. Let's look at B and C. Let me call somebody who hasn't spoken today. Who wants to go? I want somebody who hasn't spoken. Dennis Amu. Dennis, are you with us? Okay, people, please take note. He didn't respond. Let me note. Yeah, Dennis. Okay, yeah. Between B and C, which one will you choose?
I think I would go for B.
Why will you go for B? Dennis, why will you go for B?
It has a higher return.
Is it just that?
Well, at least that's what I can see from comparing both of them. I think that B has a higher return. That's one reason why
But
I would choose.
we are comparing not just return, we are comparing risk and return. Okay, so you have return on your vertical and risk on the horizontal. For the same level of what? Dennis, for the same level of what?
Both of them have the same risk.
Exactly.
Yes.
Okay, so they have the same risk, but B offers what?
A higher return.
A higher return. Very easy to see which one to choose.
Come again?
Okay. I'm saying very easy to see which one to choose.
Yes, yes.
For the same level of risk, B gives you a higher return. Right?
Yes. Yes.
I don't think it's a different choice. Okay, same level of risk. What gives you something in addition that you want? Higher return. Okay, so we go for B. Okay, what about A and B? Which one do we choose?
Is it still me or someone else?
Who hasn't spoken today wants to speak? Today's our last class, so at least I want to hear from.
So Ofosuhima is back.
Ofosuhima, yeah, I called it earlier. Ofosuhima, can you answer this question? Between A and B, which one will you pick? A and B, A and B. A and B, which one will we pick? First line, which one will you pick?
Looking at B.
You pick B. Why?
Yes.
Why B?
Because they still have the same level of risk.
No, they have different levels of risk and different levels of return. Look at the risk of A.
Yes.
Lower risk.
Okay, return of
Higher
A,
risk.
return of B. Exactly. Which one? Best mark.
Okay.
Which one you pick?
So I believe a risk-averse person will pick A, whereby someone who doesn't mind the risk will pick B. So for me, I'll pick B.
Okay, excellent answer. It depends on who you are. Okay, look at A. A is low return, low risk. So these are the guys who don't like trouble.
The entrepreneurs.
Okay, like so some people don't want to lose money. Okay, so if you remember last week, T-bills, the guy will go and put his money in T-bills. No problem. He doesn't want any problem. He doesn't want me to come and tell him tomorrow that, hey, and I want to put the money here and the money vanish. No, on pest stories. Okay, so investor A. But investor B willing to take the risk in anticipation of getting what? A higher return. Again, it goes back to everything that we said last week, that there's a relationship between risk and return. The higher the risk, the higher the expected return. And I also told you last week, and I think it's a good way to summarize that when somebody brings you an investment and say, hey, the investment returns are very good. If you're a finance person, you should know that the risks are equally high. Risk and return go together. They are like husband and wife. Where you see high risk, you see high return. Unfortunately, human beings are conditioned to think about return. Oh, the returns are good. It means that the risk is also good or high, if you want to put it that way. Okay, so investor A doesn't want risk, so low returns. Investor B is willing to take the risk in exchange for what? Higher returns. Okay, so based on that's a very good answer. Okay, let's cap this and let's finish this and close. But I'm also a bit tired now. So let me give you the essence of portfolio theory. Okay, how do we combine assets in a portfolio? In combining assets in a portfolio, negative correlations are preferred. Maybe that's how I'd want you to understand. Okay, in combining assets in a portfolio, negative correlations are preferred. Why? You see, if you get assets that are highly correlated, either you win big or you lose big. Okay, if they are positively correlated, that means if A goes up, B goes up, payday. But if A goes down, B will go down, crying day. Okay, so in portfolio theory, we actually prefer a lower correlation as opposed to a high correlation. And let me tell you the example that I usually give my students. So if you look at, let's say you live on an island, okay, and on that island, you have rainy season and dry season, okay, and there are two companies on that island. Company A produces umbrellas, which are useful when it's raining. And company B produces what? Sunglasses and bikinis, which are useful when the sun is shining or summer. Right? Now, if you buy company A, when will your investments do well? The company that produces umbrellas.
Rainy season.
Only rainy season. Dry season, your portfolio won't do well. If you buy company B, the company that produces just the sunglasses and bikinis, when will your investments perform well? During the sunny season or during summer. But when it's raining, your investments won't do well. So which is a better strategy? Buy both. So buy company A that produces umbrellas and buy company B that produces sunglasses and bikinis. Why? So that whether it's raining or shining, your investments do well. That's the essence of diversification. Okay? You don't buy only the umbrella companies. Other than that, you only get good returns on it's raining. Or you don't just buy the company that does bikinis and sunglasses. Other than that, you only get returns when the sun is shining. You buy both so that come rain or sunshine, your portfolio does well. Okay, come rain or sunshine, your portfolio does. So the last thing I need to teach you is how to use the formula. Okay, so the formula you are likely to encounter in the exam is for a 2-asset portfolio. Okay, it's for a we won't go beyond the 2-asset portfolio. Okay, so the variance of a 2-asset portfolio is given as this: weight of the first asset squared times the standard deviation, the square of the standard deviation. That's more or less the variance of asset 1. Okay, so weight of asset A squared times variance of asset A plus weight of asset B squared times variance of asset B plus 2 weight of asset A, weight of asset B. Correlation, so you know what correlation is. How the 2 assets move together. Correlation between asset A and B. And sigma A, sigma B is the standard deviation of asset A, standard deviation of asset B. So let me take it again. So this is weight of asset A squared times variance of asset A plus weight of asset B squared times variance of asset B plus 2 weight A, weight B. Correlation between A and B, sigma A, sigma B, which is standard deviation of asset A times standard deviation of asset B. We can actually derive this, but it's not important. Okay, if we had more time and in a more advanced class, we can derive the formula, but here it's not necessary. Okay, so again, this is your formula for the variance. If we go back, okay, so let's take a quick example and slot in the numbers. So let's say we have 20,000 to invest, and we put 12,000 as at A and 8,000 as at B. Okay, so we have 20,000 to invest. We put 12,000 as at A and 8,000 as at B. What's the percentage of our money invested in asset A? It's 12,000 by the total, which is 20,000. I think that gives you 60%. So what's 12,000 divided by 20,000?
Say 60%.
Okay, that's 60%. So weight of asset A is 60%. And weight of asset B was 8,000 over 20,000.
40%.
That'll give you 40%. So all we are saying is that we put 40% of our money in asset B and 60% in asset A. Okay, and if these are the returns, you can find the return on the portfolio. It's just a weighted returns. But what we are more interested in is the standard deviation. Okay, so remember that the weight of asset A is 60%. So we square it. So 0.6 squared times standard deviation of the first asset. If we go to the question, you will see that it's 15%. So the standard deviation for asset A is 15%, whilst the standard deviation for asset B is how much? 10%. Okay, so when we come here, weight of asset 1 is 60% squared times standard deviation of asset 1 squared, which is the variance, okay? Plus, what's weight of the second asset? It was 40%. So 40% squared times the standard deviation squared. So remember that the standard deviation of asset 2 was how much? 10%. Okay, so 0.1 squared. Plus 2, weight 1, weight 2. So 2 times 60%, 40%. If the correlation is 1, you put there 1. Then standard deviation of asset 1 times standard deviation of asset 2. Okay, so 15% times 10%. And when you solve for it, you get the standard deviation to be 13%. And so this you should know. Okay, you should know how to calculate the portfolio standard deviation for a 2-asset portfolio. So Kweku, please find some time and go through a few of the examples I've done with them.
Yes, please.
The last thing, so when the correlation is 1, the standard deviation is 13%. Okay, yeah. When we reduce the correlation to 0.7, so again, weight of asset 1, you square, times standard deviation of asset 1, you square, plus weight of asset 2, you square, times standard deviation of asset 2, you square, plus 2, weight 1, weight 2. Now correlation is how much? 0.7. Okay, so here you slot 0.7 instead of 1, times standard deviation of asset 1 times standard deviation of asset 2. When we reduce the correlation, the standard deviation of the portfolio falls to 12.12%. If you remember, I said that in portfolio theory, lower correlations or negative correlations are preferred. Do you remember? Okay, so in portfolio theory, lower correlations are preferred. Okay, so when we reduce the correlations, you will see that the standard deviation drops. When we reduce to 0.4, the standard deviation drops to 11.22 from 12.12. Okay, so when you reduce it to 0.4, it drops to 11.2. When you reduce it to -1, it drops to how much?
5%.
5%. Okay, so in portfolio theory, lower correlations are better, or negative correlations are better. For the reasons I explained, if the assets are highly correlated, either they are all going up, which one maybe you like, but if they're all going down, we don't like it. It means I'm going to lose a lot of money. Okay, so we prefer to have a case where, well, some go up, some go down, and we have a balance. We have a balance. So in portfolio theory, the key message is that diversification is important. That's a central message. Don't put all your eggs into one basket. Okay, spread the investments across different investments. Why? Because we don't know which assets are going to perform well. So again, if you're a Leonie and you were a financial board and you knew asset returns with certainty, what should you do? Leonie, will you diversify?
So in the case where it is certain, I won't diversify. But when it's uncertain, I will diversify because I don't know.
Okay, so if you always know like which asset will be the best, highest return, lowest risk, there's no point in diversifying because you have full certainty. Okay, but in the real world, investors don't know which assets are going to do well tomorrow and which ones won't do well. That is why in the real world, we see that investors don't hold a single asset. They spread their money across different assets. So at the beginning of the year, okay, I want to invest. I'll put some in let's say, cryptocurrencies or Bitcoin. I'll put some in the stock market. I'll put some in oil. I'll put some in other assets. Okay. The point is that I don't know which ones are going to do well. If I did, I'm better off putting all my money in the asset that would do well. Can you see that? But in the real world, investors don't know asset returns with what? The certainty. And therefore diversification is important. Or they decide not to put all their eggs into one basket. and they decide not to put all their eggs into one basket. Okay. I think we can end it here. Today has been a long stretch, so I know you are equally tired. Okay, but this will be my last session with you. Just a moment. This will be my last session with you. So you will sit the same exam with the weekend students. The exam I think that we are going to do, so don't come back and stone me if it's wrong, but I'm going to speak to Ben. It's likely that we'll do online. So we don't like online because we know what you guys do. In fact, I told myself that the online exams, I'm not going to do it again. Okay, but because of COVID-19, and that's your saving grace, because of COVID-19, we've been admonished to consider it's better. We know you guys cheat during the online exams, but it's probably better than people losing their lives. But please, as much as possible, do the work yourself. So what we are going to do is that we are going to restrict the time, so that even if you are cheating, you will suffer. That's all we have to do. Okay, I'm going to give you a lot of time. Ideally, I would have done face-to-face, but the dean has admonished us to. It's better that people, well, we know you are likely to cheat, but it's better than people losing their lives. Okay, so it looks like we'll do online, but the time will be restricted. Okay, that's what I would have to say. But I haven't discussed it with Ben yet, but I think that you will agree. At the beginning of the semester, we said we were going to do face-to-face, but given the admonition from the school, it's likely we'll do online. Okay, so that's what I have to tell you. I have set my questions already, but given that I taught you, so I set my questions already, but not on risk and return. But I may add something on risk and return, given that that's the topic I have done. Okay, so that's what I can say. I have two other questions on, I think they're on capital budget. Yeah, there's a question on capital budgeting, and then, yeah, I think on capital budgeting. So internal rate of return, modified internal rate of return, calculating MPV, profitability index, etc. Okay, you should be comfortable with all that. So internal rate of return, modified internal rate of return, MPV calculations, profitability index. And that's what I can remember from the top of my head. I think there's a question on bond valuation as well. So you probably want to consider that. I don't know what Ben will set, but these are the things that I have in mind. I may add another question on risk and return. So Kweku, the questions you are doing with the weekend students.
Yes, please.
Just find a session or two and do the same thing with them.
Oh, okay.
I think it's fair. And there are not many. If it's also possible, you can probably, if you want to reduce your stress. But the weekend guys are many. Oh.
Usually tutorials, I have about 30, 34, 35 maximum in the class.
Okay, then you separate them. Other than that, they maybe
Yeah.
tutorials, you want to give them the opportunity to be able to interact and ask a lot of questions. So you separate them. So just do 2 additional or 3 sessions with them, and then
Sure.
And then you see your benedictions for them. You leave them in the hands of God.
Leave them in the hands of God.
Okay, guys. So I think we'll end here. Thank you for your time. It was interesting meeting all of you. I wish we had met face to face.